Kick it off, big dog.
Hey, Tyler Ross Real Estate in Warrenton, Virginia. My man Dave Couk.
Dave Couk, mortgage loan originator, Integrity Home Mortgage. We're wanted to get together with Tyler again. I know that at the beginning of the year we kind of did a state of the real estate and mortgage market, and here we are, the last day of the first quarter, and it happened fast, and so we just wanted to get back together and kind of give you some insight as to what we've seen happen in the first quarter.
Yeah, me being the broker and agent, him being the mortgage officer, loan officer, we have kind of our fingers and thumbs on the pulse of what's going on from slightly different perspectives. So it's always fun to talk with Dave about what we're seeing out there. Can I start us off with?
Start us off.
So I'm going to give you a quick inventory update on Fauquier County. Fauquier County has 118 houses for sale presently. I'd refer to 11 of those as being fixer-uppers, 30 of those are over $1 million, and 21 of those are paper houses, houses that have not been built yet. So if you're looking for a house in Fauquier County to move into from Gold Vein to Bealton to Marshall, you're looking at 56 options under $1 million, which is pretty tight. Of the 118 houses, 46 of those are in Warrenton, and then the rest scattered across the county. So I think that speaks volumes to anyone that is in the know of inventory levels. For the last 15 years I've been doing this, I've been used to 350 to 500 houses. So inventory's tight, but there's hope.
Yeah. So just a couple of things. So when I come across some statistics, I love numbers, of course, being a lender. But a couple of things that jumped out at me. I saw a report the other day saying that the 4 weeks ending February 12th, that 20.5% of the U.S. home sales that closed above sales price. And that's versus 40% closing above sales price a year ago. So correct me if I'm wrong, but that tells me that the rapid acceleration in home sale prices has started to decelerate a little bit, and probably along with that, although it's not yet reflected, I also read that shelter costs peaked in November of 2021 and have been decelerating. Mm-hmm. Still not yet reflected in all the economic data, but the optimist, the glass half full in me, says that as we go forward, that may help drag some of this inflation down that the Fed has been so vigilant to fight, and that we could, I guess for the folks out there that are thinking you're going to see some 40% decline in housing prices, and so you're sitting there waiting to be the vulture to come in and scoop up, probably not going to see that. Inventory's too tight, supply and demand just is not going to dictate a scenario like that, at least not in our marketplace.
No, I wouldn't think so. We enjoy the insulation and stability that, being in the DC area offers. So nationally, I wouldn't be surprised to see, more declining in pricing, but we stay pretty sticky here as a result of the, kind of booming industries around DC metro area.
Okay. One of the things that I had wanted to ask you was, since our talk in the beginning of the year in January, what are you and your team doing differently? What are you seeing that's a little bit different in the market out there, and what are you guys doing kind of in response to, you got to ebb and flow. You got to, you got to be flexible and adaptable, as one of my old bosses used to say, flexible and adaptable. So what are you guys doing particularly in this market?
Well, a lot of it's communication with, people that are buying or selling, and helping them kind of understand the impact that the increase in interest rates have had, and then the response that lenders like you have had coming up with new products to help people get them into homes. So education is a big one. It's a really good time to be good at your job. We're seeing a lot of, I won't go down that hole,
right.
But
I know what you're saying.
That's one thing, and then a lot of it is managing expectations as a result of the wild increase in prices that we had, and just kind of resetting the expectation that it's not that time anymore, and pushing buyers off the fence with the new loan products. And then we're seeing more seller subsidies, more seller paid closing costs than we did a year ago. Less competition, it's still high, prices are still high. I'll credit that to the lack of inventory, not a whole lot of supply, so that's keeping prices pretty stable and high. But it's still buying and selling houses, and there hasn't been a whole lot of dramatic shift in the way we do things as an office, because we are consistent and stable, year in, year out.
Just sticking to the blocking and tackling, standard stuff.
Yeah.
Now, one thing that you just said that got my head spinning a little bit is the seller subsidy. So last year, and we actually talked about this a little bit at the beginning of the year, but kind of the shift last year seemed to be around June, where suddenly I started getting ratified contracts that consistently had seller subsidy, and then around February it vanished. Like, I'm not seeing contracts right now with seller subsidy unless it's a really rural property or property that for whatever reason has been sitting on the market for a while. And I've noticed that a lot of our borrowers that are trying to buy and are in a competing situation are not winning deals if they're asking for seller subsidy.
Yeah, which I'd imagine most of the time is an effort to buy down their interest rate.
Yeah, we're definitely seeing some of that. Interesting stat that I saw recently, Fannie Mae said that over the course, I want to say it's the last 6 months or so, that more than 65% roughly of all loans closed had points being paid in an attempt to buy the rate down somewhat, and in some cases multiple points. Now, when you get to, and I had this discussion with a client yesterday, when you start looking for investment properties, you're paying points.
Yeah.
You're paying points, and in some cases, you're paying a lot of them. And I showed him an example of, if he was buying a primary residence, there's par pricing. He can get a rate, low sevens with no points, or he can pay part of a point down to multiple points and be, in the mid to low sixes if he wants to. But on the investment property, if we just switched his loan to an investment property, same purchase price, same location, boom, he's looking at like 4 points right out of the box.
Yeah.
Which I think is a good time for me to mention this. So 30-year mortgage rates have traditionally been triggered by the yield on the 10-year treasury. So what banks typically do is they look at the 10-year treasury yield, and then they add, on average, anywhere from 1.5% to 2% on average over and above the yield on the 10-year treasury. So they track it, and then they've got a buffer built in there. That buffer, I guess if you wanted to be precise, is probably like 1.8% on average. Right now we're tracking 3% above. And the banks are nervous. Okay, we've had all this talk about recession, struggling economy. You got a war going on in Ukraine, and now, since we last talked, you got this little banking incident that came up, and as a result, we're seeing, certainly on our side of the street, we're seeing underwriting standards as tight as they have been. I've had no less than 3 of our underwriters apologize and just say, hey, trying to approve your loan here, not trying to be a pain in the butt. We're really seeing our feet held to the fire. The investors buying these loans want every T crossed, every I dotted, no wiggle room. Sorry, I'll get your loan approved, but I need some additional stuff that, and I'm just sorry.
Yeah.
So back to your point of communication, we're having to communicate to borrowers that no matter how pristine their credit may be, no matter how many documents they may have given us, there's pretty good chance that the underwriter's going to come back and need something else to round out the file to satisfy the investor that happens to be buying that particular loan. So again, not to go too far back in time, but a couple of things that I noted different from 08, 09 when we had, the real estate and mortgage collapse. First of all, the underwriting standards were, you fog mirror, get loan. So there was nowhere near the tightness of underwriting that there is now. And also, I read in a fresh report today that our banking system, as much as they've been in the news lately, is sitting on roughly $3 trillion in cash reserves versus close to zero. Yeah. Back when we had the global financial crisis in 08, 09. That's significant. So I think one of the things that we're starting to see, you may have noticed, is the stock market's been, getting a little bit of air. So there seems to be this feeling anyway, and all eyes were on Jerome Powell the other week. To see not just is the Fed going to raise rates, which they raised 1/4 point, that was expected, but what his words were, and the financial markets hung on every word coming out of his mouth, and he indicated that we may be closer to the end of the tightening cycle. Again, nobody knows. Right. But the markets seem to take that to heart, and so we saw the 10-year Treasury yield peak on March the 2nd, and by March 24th, it had dropped 0.7, almost 0.75%.
It's a big move.
Yeah, big move.
Quickly.
Now, one of the things that's interesting is the 10-year Treasury yield dropped pretty significantly in 22 days. Mortgage rates did not drop in lockstep. Part of that is the conservative nervousness, if you will, of the banking system. Right. So, thing with the banks, they're quick to raise rates when the yield on the 10-year goes up. They're slow to lower them when the yield starts coming down. And part of that's just nervousness right now.
Sure. And well, to speak to your point in regards to the tightening of the underwriting, this is advice that we give all the time, but particularly now is get in touch with your loan officer as soon as possible, because there may be more boxes to check than there otherwise would have been when underwriting was a little bit looser. So if you're thinking about buying a house, take action now with your loan officer so that you can get in front of any potential conditions that you would have to get your loans.
Yeah, it just makes for a smoother, more seamless process. And again, underwriters are not, certainly at our company, our underwriters are all in-house. Our processing, underwriting, and closing team, they're all part of the team. They're in-house, so we don't farm that out. I like to say we don't farm out these important duties to people in states we'll never visit, to people we'll never meet. Right. These folks are all on our team. I talk to them, work with them on a regular basis. They don't want to be a pain in the butt. I mean, they don't want to create any more work for themselves than necessary. But our underwriters, like most underwriters, I suspect, get graded on how many loans come back where the bank on the other end buying loan wants us to, give them more information, or they have a problem. So underwriters don't want that to happen because it doesn't look good, on their report card. So they're just doing their job, and part of the reason why I don't see anything remotely close to what we had 08, 09, because people that have gotten loans the last few years are people that damn well qualified for them.
Yeah, most definitely.
It's not fog mirror get loan like it used to be.
That'll give you a lot of confidence that those were strong loans, and we're not likely to see that kind of impact in 07, 09 of people defaulting on those loans.
So one question I have for you, Tyler, since you handle the listing side for Ross Real Estate primarily, On the listing side, obviously in this market, particularly in our marketplace, it's mostly a seller's market. But how do you go in and talk to a client that's interested in selling their house and convince them in a market where it looks like, you know, they're seeing their neighbor put a house on the market and sell it in 2 weeks? What do you tell them to help express that there's still professionalism and value that a good agent, even on the listing side, brings to the table in a market that right now probably favors the seller side a little bit more?
Sure, yeah, it's certainly a mastery or deep understanding of the contract and making sure that that client is protected in every paragraph, because there are some kind of peculiar choices of words that the contract board or committee put together. Also, again, expectations. You know, you have a long-standing reputation of doing your job and executing it at a high level. You can convey with confidence and build confidence and trust with your client through that experience to set reasonable expectations for them. So it's really about earning trust through your ability to communicate and to express how your experience can inform and make easier their experience of buying or selling a house.
Yeah, I would think that it gets, you know, a market like this, it gets a little tougher on the listing side. If someone just watched their neighbor list their house and then get a contract in a week, you know, and that house maybe sold, you know, the example, you know, because I know of a situation right now where one of my clients is looking to buy a house, saw their neighbor sell for, I want to say $640, but I know the agent that is selling their house, and they told me personally, well, I'm not going to list it at $640 because that house had significant upgrades. I don't want to insult my client by telling her, you know, your house isn't as nice as that one.
Right.
But the reality is it should be listed lower. So that's a part of your job that I don't envy, because that's a tough conversation. You know, you got to walk a fine line. You don't want to offend anybody, but at the same time, you have an obligation to be as honest and transparent and truthful as you can be. And I guess sometimes that may cause you to lose a listing. That
lost a lot of business as a result of being honest. But no, that's really a true thing. Everybody thinks that their peach is kind of the sweetest peach on the street, and so being able to not just express that might not necessarily be the case, but to provide evidence and reasoning in a way that a person can understand and get their head wrapped around is important. So again, it's experience and confidence and your ability to communicate.
Well, you know, I hate the idea of a crystal ball, because nobody has one. Nobody can predict, you know, with any certainty what's going to happen. But how do you feel? So tomorrow is April Fool's Day, and the beginning of the second quarter. What do you anticipate seeing over the course of the next 3 months? What is your, if you had to take a pen and paper and write down the script, not for what you want to have happen, but what you think you will see happen in the next 3 months, what would that look like?
It's great. I could spin myself in circles going in any direction at all. But given that you know, Jerome Powell just did the 25 bip increase on the rate and is indicating that it might be time to slow down, that could be favorable in terms of loosening up some lending. It's going to be hard for a lot of people that have locked in these low interest rates to move, so I'm expecting that inventory will remain tight, with exception to what the White House or the Fed could do with the stroke of a pen. if we were just to rely on basic economic indicators like we have been in the past, and I'm not so sure we can now. I feel like inventory will continue to be tight, and I think we're going to be fairly stable going into the next quarter. There are a lot of factors that could change that right away, whether it's war or China talking about using the what happens to the U.S. dollar and the currency that's going to be used to evaluate and trade oil. All those things could play a big role. But as it stands now, all things being equal, we are on a path of what feels like a fairly stable real estate market.
Okay. So one of the things that I've been thinking about, I do some of my best thinking at the gym when I got my headphones on and I'm just in my own little world. But one of the things I've thought about the last couple of days is people move for all kinds of reasons. People move because their family's growing and they need a bigger house. People move because they need a bigger house, not because they're kids, but because they have parents, aging parents that are moving in, and it's cheaper for them to, rather than put them in a nursing home or, whatever, they move in with them. People downsize, people upsize, people get transferred for work. And I got a really interesting call yesterday. Some folks are telling me that they're about 10 years out from retirement, and they feel like with the equity they have in their home in the neighborhood where they live, they've kind of maxed out their potential for growth in value. And they want to go to a bigger house, not because they need a bigger house, but they want something that they feel has more upside equity growth, so that they'll be in a better position when they retire to downsize from something.
10%
okay,
on
I
a million.
hadn't thought about that.
10% on a million is more than 10% on 500,000.
Yeah. So my thought and what I'm trying to convey to our clients on a regular basis is the market is tight. Inventory is tight. It's not likely to. There's nothing happening that's going to loosen up inventory to any degree right now. So inventory will probably remain tight for some while. But it's not baseball. It's not 3 strikes and you're out. It's batting practice. You get to look at pitch after pitch after pitch, and there'll always be another pitch because there's always a reason someone has to sell their house.
Yes.
So you just got to make sure, I tell my borrowers, do not put the bat down, because you'll miss the fat pitch that comes across the plate. Case in point, had an older lady I was working with. She was a year searching for a house. Very specific price range. She needed to be, 230 or below. Inventory tight. A lot of the houses she looked at were pieces of junk. But she didn't give up. She just broadened her search to the extent that she said, you know what, I'm working from home. My job lets me work from home. Why do I have to be in a specific area? Broadened her search, ended up buying a diamond in the rough out in Martinsville, Virginia. The property appraised for way more than $220 that she paid for it. And she got an accessory dwelling unit that had been built on the property that was already rented out. So in addition, rental income. And she could easily have given up after the first 3-4 houses she looked at, but she didn't. She never put the bat down, and she got a big fat pitch right across the plate. And that thing appraised for a good bit more than what she paid for it. So, my advice to borrowers is, get with your lender early, get pre-qualified, make sure that the process can be as seamless as possible, and just recognize that it's batting practice. You can't strike out.
Yeah, and a lot of people that are on the fence now as a result of the interest rates being higher than they're accustomed to. My dad tells me stories about refinancing to 14.5%, feeling like a genius back in the, was it the late 80s or early 90s? But to me, it's not about the interest rate, it's about the cash flow, it's about the payment. If your payment is manageable, and frankly, if you divide your payment between between interest and mortgage pay down, if you're paying rent of, say, $2,500 a month, and your mortgage is $3,000 a month, and $700 of that is interest, that your rent just has to be less than the interest. Everything else is a piggy bank. It's going towards the equity of your house, the pay down of your mortgage. I thought that was an interesting perspective, but I'm a payment guy. If you can afford X a month, doesn't really matter.
Well,
what the interest
to
rate
your
is.
point, so last year around this time, precisely around this time, many, if not most, of my borrowers that had been pre-qualified in the previous 3 to 6 months had been pre-qualified with rates that were extraordinarily low, 2s and 3s. Suddenly, rates went up so far, so fast that anyone that hadn't quickly gone out and gotten a house, gotten ratified, or maybe just kind of put it on hold for a while and then came back to me, were so shocked to see how far rates had gone so quickly that it really stunned a lot of people into just doing nothing.
Yeah.
Who wasn't stunned? My first-time home buyers. They had nothing to compare it to.
Yeah.
So to your point, my first-time home buyers last year, every single one of them, all they want to know, what's my payment and do I qualify? Because renting sucks. I'm tired of paying.
Yeah.
You know, my landlord isn't fixing this or that. The house has got mold. I want to start building some equity. So I hardly remember a first-time home buyer really asking me much about rate last year. I mean, everybody was watching the news, so they knew rates were higher than they had been, but they had nothing to compare it to because they hadn't owned a home. They just wanted to know, do I qualify for the payment?
Yeah, and the payment is, I mean, ultimately there's cycles in real estate. Your house is going to be worth more one day, less another day. As long as you can manage your payment, that doesn't matter so much. As long as you're not compelled to move by your work, or if you manage your payment, you won't be compelled as a result of finances. So it doesn't matter. Manage your payment, whether you're upside down in your house or you're building great equity, doesn't matter until you have to sell your house. So if your payment's good, you're in good shape.
You got anything else? Because
we go on for hours.
I know. Well, when you love what you do, it's easy to talk about it all day long. But I think that's as good a place as any to stop. We'll try to do this on a regular basis, and hopefully we add some value or just give a little bit of insight to folks. I'm Dave Couk, mortgage loan originator with Integrity Home Mortgage.
Tyler Ross Real Estate here in Warrenton.
Thanks.
Buddy.